Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 30 minutes here on Options Guide TV. Today's date is tax day, April 15th. The markets are open and they are rocking and rolling. We're going to be looking at our general trade this week. A lot of news, obviously, over the weekend. We have a conflict going on with Iran and Israel, and that has affected the markets. But we also had some manufacturing numbers that have came out, and they were extremely strong. The market has reacted by raising interest rates. The 10-year yield hit 4.6%, but the market decided that's a positive thing. Not 100% sure why. And the market has been fairly strong, but now it's giving back some of the gains that it had this morning. So mixed would be a good word as far as considering the markets. The IWM, the Russell 2000 index, is the one index that is probably taking it to the chin the most. And that has to do with the fact that obviously interest rates are going up. The probability of the Fed cutting is probably something that has taken the hardest as far as the markets are concerned. By looking at the next Fed meeting that's coming up, which is in 16 days, nothing's really changed there. As far as that Fed meeting is concerned, there's basically no chance at this point in time that they are going to cut rates. But everybody has had their eye on June, and the June expiration has changed quite a bit. We went from basically a 50-50 chance that they would cut rates in June to now we only have a 20% chance. And the movement, to actually just looking at it over just 1 week's time, 1 week ago it was 51.3% chance that we were going to have going to have a rate cut, and now it's bounced all the way down to about a 20% chance. So the strong manufacturing, just the data overall, jobs market, consumer is still strong. And so overall, the chance of it happening in June has gone down quite a bit. So then let's go all the way out to July 31st and look at that probability. That probability now is around a 41% chance. Oh, plus 7, actually, you can throw that one in. So we're going to call this one a 50-50 chance that by the time we get out to July, that there will be at least a 0.25% rate cut. Now, the way that this chart works, now that we're showing it, is the current rate is 525 by 550. So this is where the current rate is at. The probability of a quarter point cut is 41%, and then they're also pricing in a 7% chance of a 50 basis point cut in the Fed. So that's where the markets are at, and the markets have taken this as a positive today. Markets are up. I would have guessed that they would be down. The IWM is definitely down, and we talked about that on Friday's show, that we were in a range that if we could have got a little bit of momentum to the upside, and basically the understanding that the rate cuts were coming, that whole picture has changed. And now if you're going to go anything with the IWM, you want to go lean to the bearish side of things. It's at a kind of a support and resistance area, and we will look at that a little bit, but we're going to delay the trade that we were thinking about doing in the IWM. Now, I'm going to keep the theme of looking at an S&P 500 index trade. There's some weeks that will take off, but most of the weeks we try to do something on a weekly basis in the SPX. Right now, well, last week we actually had we looked at a skip strike butterfly on Monday. We set up a paper trade on Monday, and that was very apparent that we were going to make the net credit from selling. Or I don't even know how you actually say it with a skip strike butterfly, because you're buying the butterfly, but you're receiving the credit. So when we're receiving a credit, you have a tendency to say that you're selling the butterfly. But ideally, you're still buying the butterfly at a net credit to the account. And that's what we did on Monday of last week. Those options all went out worthless, and we made the net credit. So it was very apparent that we were going to go out worthless on those option contracts. So we actually put on a bearish trade on Wednesday, and we did a butterfly, and we also looked at a calendar spread. The calendar spread did really well, mainly because the pump up in implied volatility that happened. And that is good for calendar spreads if you got the market going in the right direction. So that trade worked out. The butterfly, we went a little too far out of the money. It took, there were times where it was profitable, but they were very short lived. And it would have been hard to try to get out and make that trade a profitable trade. It was a small loss if you got out at any point in time throughout and a lot of those different opportunities. Okay, so this week I think we're going to go back to that skip strike butterfly. So I wanted to go to the options playbook, and I wanted to share with you the skip strike butterfly. So here we have it. Options playbook, skip strike butterfly right here. We're going to look on the call side of things because we're really going to be more bearish on this trade than anything. I've always billed this as an alternative to a short call spread, not an alternative to a butterfly, because what I'm thinking when I'm looking at the skip strike butterfly is that I want to sell some premium and I want to have a protection and have a hedge on my position when I'm selling that premium. So here's the alternative trade. If I was doing the skip strike butterfly, I'm thinking to myself, well, to start with, I wouldn't mind selling a short spread. Implied volatilities are still up, even though the market's up a little bit today, but we still get the VIX trading right around 17%. We're going to sell the strike C and buy strike D. That would be a short spread, bringing in a decent amount of credit. We're going to go about one standard deviation out of the money. So we're selling something that has a delta right around 17% or 16%, right in that range, and bringing in a decent net credit. But then we're just laying out here naked on our short call spread, if you will. And I use naked in quotations because we are hedged a little bit. But the way that I looked at the skip strike butterfly, whenever I'm approaching it and I'm treating it more as a bearish trade to neutral, and then we have an alternative when it's all said and done. And if the market comes back, we'll have a possibility at a home run. But what we do here is we take this credit from selling strike C and buying strike D in the big picture, and we actually purchase a butterfly. And that butterfly is a standard butterfly. Buy strike A, sell to a strike B, and buy strike C. That's a standard butterfly done for a few cents in the S&P 500 index. If you're looking at weekly option contracts, especially with the VIX at a higher rate than it's been recently. So butterflies get cheaper. So that's why we're going to approach the trade this way. And I'll start with that. And then also we have a lot of earnings that are coming out. Goldman Sachs actually had a solid earnings report, up about 4% on the day, at least on the open it was. And I think it's still hanging right around there. And so that's a good thing, for a good step for the financials. We had Charles Schwab also announce earnings, and they are up today. So we do have higher interest rates, and the interest rates are kind of finicky with some of the banks. It obviously depends on how much the banks are paying out. Goldman Sachs is more of an investment banking firm and a trading firm, and those numbers in those divisions were up, and that's part of the big reason why Goldman Sachs is strong today. But you have other stocks. Schwab is a little bit more interest rate sensitive. JP Morgan also a little bit more interest rate sensitive. So it's good to see that Schwab is up today with the rise in interest rates and the way the market is going. They had another strong quarter too. So we have tomorrow in the banking sector, we have IB, and we have PNC, and we have Morgan Stanley. So in the financial sector, I should say, Interactive Brokers, and then Morgan Stanley, which is got the banking component too. PNC Bank. We also have Johnson & Johnson announcing tomorrow. Some of them are after the close. Some of them are before the open. Bank of America is before the open tomorrow. And then on Thursday, we're going to kick off, a lot of the tech stocks. So you have the first one of the FANGs, which a lot of people aren't using that acronym as much. It's all about the Magnificent Seven, basically because of NVIDIA. But uh, Netflix is a company that's persevered. There's everybody is always through years and years and years saying that they are trading at too high of a valuation, but they keep getting that valuation and they keep being a strong company and they keep reinventing themselves. They put out more content than any of the other streaming services. Almost all of them combined don't put out the amount of content that Netflix does, and because of that, they're still strong, and they're going to be announcing earnings excuse me, on a Thursday. I don't know where that came from. Also have Ally Bank, and then Friday we have American Express before the open. So big week of earnings. Now, before I get into our first trade, if you have any questions and you are in the YouTube platform, if you do on the Tradier YouTube page, you can put them in the chat box and I will try to address them during the show. We try to make Options Guide TV as interactive as possible, but you have to interact in order for it to be interactive. So if you have any questions about any of the trades, we're going to start by putting on our SPX trade, and then we'll just kind of look around. But I think the earnings trade that we're going to look at is going to be a Netflix, and it's mainly because of the day that they're announcing. They're announcing on a Thursday. That means that either we're going to do a trade that expires on Friday, or we might go out another week in time. But that's where we're going to go as far as Netflix is concerned. And that'll probably be the one company that we'll focus on for earnings this week. All right, so I'm going to jump back out and we're going to go to the TradeHawk software here. And let me pull that up. And I have the trade all set up. So let me highlight a couple of things in the watch list. We're seeing, well, first of all, last week we did review Google, and Google's kind of been of a little bit of a pain in that we sold a call on our deep in the money call position in our paper trading portfolio, and we've had to roll it about 3 times now. So we're now at the 160 strike, but what's a real pain is that Google's going to be announcing earnings. I think they're going to be next week. They usually are the week after Netflix. I haven't actually looked at it, but yeah, we're right at the 160 mark. So I might, if I get an opportunity, if Google does sell off a little bit, I might buy the call back in. So I just want to let you know, because it's been a pain, it's been a struggle. If I can remove the obligation of being short that call option at a decent price, I'm going to probably put a limit order in at a lower price to buy it back and close out that position. I'd be happy to do that. Take my comeuppance, say, I was wrong. The market was stronger than I thought, but ideally the position is doing really well because we're long like 4 calls in Google, and we've been long it since November of last year. All right. Now, VIX, like I said, above 17. When the VIX is up, butterflies are cheap. And if you do a butterfly and the market does go up, this is why, like with skip strike butterflies or butterflies in general, I'd rather do them directionally on the call side of things or on the bull side of things, because as markets go up, implied volatilities go down, and they have a tendency. And when that does happen, if you land within the wings of your butterfly, you want volatility to come off because you have those 2 option contracts that you sold, and that's where you want the market to go to. You need to close those, so you want them to be trading for the least amount of premium period when you go to close them, and the VIX being lower obviously helps that. So let's set it up. Let's do it. This will be the paper trade this week. We're going to go back to the well of the skip strike butterfly. And today I'm a little bit more bearish than I was last week as far as my mind is concerned. We do have earnings. We've got a little bit more volatility to the market, if you will, in that we have so many companies announcing earnings. Something could happen. And that's always a possibility in earnings season. But I still want to do this trade, and this will be the official paper trade for the week. Here we are. SPX at 51.27. We got the call side of our chains. If you notice the box around the April 19th expiration, we're going to go out till Friday. And I thought about doing a Wednesday trade because we've done it a couple of times. I just didn't get enough premium. and I'm a little bit more bearish on the marketplace. If I was a little more bullish, might make it a little bit more short term, looking at maybe a Wednesday trade where if the market does start going towards our strikes, we can have the potential of it landing within our wings. And I'd rather have that on a shorter term basis, because if it moves against us too fast, the trade initially starts out as a bearish trade, wanting the market to stay where it's at or go lower. Okay, so, and if you have a question on that, please throw that into the chat box and we'll check that out. I see that Wayne's already in there. All right, so I have, before I get into the butterfly, let's address Wayne's question. Let's put that up. Okay. Hey, Brian, I've heard the term that options give you asymmetry when trading. Can you show us an example of how that works when picking the optimal deltas for the trade? Asymmetry. The optimal deltas, that is a loaded term. If I'm looking at a trade and I'm trying to pick out what strikes I want to use, we're using delta as probability most of the time. Even though that's not the textbook definition of what delta is, it's trying to tell you how much your stock will move your option will move relative to a stock price movement. So in this instance, the terminology and the aspect that you're talking about, Wayne, I'm not familiar with. So I will talk about the delta when picking out this trade today, but I'm not, to me, that leans towards a delta neutral scenario. And when I'm working with retail traders, I don't really focus on delta neutral. You may adjust a large portfolio, but we're making our own trades. And when we get to pick the direction as a retail trader and the market makers are trading with us, they're the ones that are worried about the delta neutral. Now, there are some retail strategies out there where you're trying to scalp gamma and try to stay delta neutral. And some people will take that approach. I personally don't, especially on the retail side of things. I think transaction fees, bid-ask spreads in this day and age, transaction fees have came off quite a bit. Obviously, in TradeHawk and Tradier, they've done a great job of lowering fees, allowing a monthly fee to be able to trade options as opposed to a per transaction cost. And also, just bid-ask spreads. That's the benefit that market makers have. They're buying on the bid, selling on the ask. We got to pay the ask, and we got to receive the bid when we sell something. So I'm just going to mention delta, and I've done it before, that if we look at this trade that we're setting up, here's where the market is at, 51.25. Going out about a 1 standard deviation move, you're going to look at the delta. That delta is going to be fairly close to 16. So we want to be within the range, but they're saying there's a 16% chance of this option contract finishing 1 cent in the money. Market's kind of moved against me. I think I'd almost want a little bit higher probability, because I'm looking at the credit. When I started this, it was around 70 cents. Okay, we're there. We're back. Dealing with live markets. I'm going to keep it at 70 cents. I think that's the credit that I want to get on this trade. And if anything, I would actually move down $5 on the trade to try to get that 70-cent credit. But we're right around there. I saw 67. All right, I'm going to leave it at 70. That's the midpoint. I think the markets are moving around enough that you can get a 70-cent net credit to the account. It's always a risk. It's always a gamble. You never know if you're going to get a midpoint fill or not. There's never a guarantee of it happening. But markets are really moving right now, and I think there is a chance you'd get filled at this price. Okay, so let's get to the trade. 52.20. We're buying that strike when we're selling 2 of the 52.30s, skipping the 52.40s, and buying the 52.50s. Looking to get a net credit of 70 cents to the account. By skipping the 52.40, we're adding a margin requirement on the trade. The requirement will be from 52.40 to 52.50. It will be 10 points, or it will be $1,000 on that trade. We're bringing in a net credit of 70 cents. If we just did the short spread, let me send this to the what if calculator, and we're going to make this official trade. So let me read this back. I'm going to send it to the what if just so that we have it loaded somewhere, and then we'll come back to the trade screen. And if we just did the short spread, so we're looking, I always want to compare that. So remember, my definition using the playbook is we're selling the credit spread to pay for the butterflies. So I'm going to remove these legs, the ones that we bought. All right. And we're going to add this one in. So this would be the short spread that we'd be looking at. And we're talking about a 95 cent, and I'm giving myself a nickel over on the other side. So let's call it $1. All right. That's staying pretty stationary at 95 cents, but let's say we could get $1 for it. So here's the trade-off. If we sold this, we're at a delta of 9, so we're further out of the money, but our risk still kicks in at the same spot at expiration in the skip strike butterfly, where it's not as apparent, but that's where your risk comes in, is right at 52.40, that strike that we skipped. And the way that I look at it too on the butterfly is that if you did a standard butterfly, you would have bought that strike, and then if you would have sold the short spread, you would have sold that strike. So they would have offset each other. And hence the reason why I like it called a skip strike as opposed to a modified, or just the other different names that a lot of instructors will use. I think this one explains it better. We're skipping that strike, embeds that credit spread. So you got $1, you're making 30 cents more, but if the market starts going against you, it's going to hurt right away. If it gets closer and closer to expiration, it's going against you. You got to really consider just getting out of the trade. Whereas with the skip strike, as time goes by, and let me adjust this, we'll bring this down, and I'm going to zoom in a little bit. Here's where the market's at, 51.25. And with the skip strike, it hurts right away just because of the short spread. But as time passes, as time goes by, we're on the 15th. Let's go up to Thursday. And that's 11 o'clock on Thursday. Notice this line starts drifting that way. Now this will be 11 o'clock on Friday. And now we're profitable. And that's 11 o'clock on Friday. And from that point in time, it's going to skyrocket up to this level. So for a half a day, you have the markets a very good probability. This is ideally where you would want to be if you can have your best case scenario is at 11 o'clock on Friday, you would want to be right here, right at the strike price, and have it drift towards the middle as expiration approaches. So then it doesn't force your hand. You're not over here where this huge cliff, steep cliff is, and a lot of risk is on that trade. If you're somewhere within this range, I would rather be in the skip strike butterfly all day long, give up that 30 cents of the net credit on the short spread, and just let this trade ride and see where I'm at. And not only could you get the net credit, you could sell this for a credit too. So you bring in 70 cents and then maybe you sell it for $2. So you're $2.70, and you're making way more than you ever did that you ever could on the short spread. So that's another way to look at it. So I got another question. Is a skip strike butterfly the same trade as a broken wing because the width of the spreads are different? Yes, it is. It's another name for a skip strike butterfly is a broken wing butterfly, modified butterfly. And if I'm not going to run back to the playbook, but if you look at the playbook, we have the AKA underneath skip strike butterflies with calls, basically showing you some of the different names for a specific strategy. Thanks for the question, Wayne. All right, here we go. All right, so that's our official paper trade for the week. And I'll set this back and I'll give you a quick read back of that trade. What if calculator? Let's go here. Click, click, click. Come on, baby. There it was. Need to add the one wing. Wasn't taking it. 40, then 50, and we'll buy this one. All right. So I'd like to get it for 70 cents. Yeah, we're there. I'm going to keep it right at 70 cents. That's where I would start working this order. We're struggling trying to get that net credit, but that's where I would want to be. And that'll be our official paper trade. We are placing an order to buy the April 19th, this Friday, expiration, 5220 strike call, selling 2 of the 5230s, buying 1 of the 5250s. That is a 1 by 2 by 1 unit butterfly for a net credit of 70 cents to the account, or $70 less any fees that we have to pay to get into the trade. You're going to have a $1,000 margin requirement. Your risk is from 52.40 all the way up to 52.50. That at expiration, that's where your risk starts to kick in. And that's our official paper trade. All right. So now I'm going to come back and let's look at Netflix. We're getting to the end here a little bit, but actually let's look at IWM, because I am curious in IWM. We did a long straddle right at this point, I'd say a couple of months back. So let's go look at that chart, and we got IWM up. All right. So mentioned many times with IWM that it doesn't usually like to follow the chart rules, but all of a sudden it's kind of came in line. And a very interesting point. See right here, I'm going to highlight it on the chart. We hit to the top of this white candle here, and we went right to that point, and then we started to sell off. Now we're back into this trend line, and we're back in this range. And this area here, if we did, now this is zoomed in, so this goes back to December of 2023, and here's December 6th. But on this day in particular, we had the big gap up, and then a much bigger gap up. This is when the talk of interest rate cuts were coming in. And this area, look at how many times we've filled that gap. We filled it here to the downside, here to the downside. So right in this range. Here's another one, 1, 2, 3 times. So a lot of volatility between these prices, 194 and 197. So if we break down, there's a good chance we come back down to this range, another 4 points on the downside. And right now, the path of least resistance, especially considering the talk of the marketplace and the way that the 10-year is acting by going up to 4.6%, and then also the probability of a rate cut decreasing precipitously all the way down to about 20% chance in June of that happening, as I think the path of least resistance right now is to the downside. And we're looking at 193 here. So if anything, right in this range, I would think about another long straddle. I don't mind that at this point in time. The only thing is that implied volatilities are elevated across all markets. So you would be paying up for that long straddle. I'm not going to do it officially today. I was going to talk a little bit more about Netflix, but we were running out of time. I appreciate all the questions, by the way. Thank you, Wayne, for participating today. And we will come back on Wednesday. We'll look at where the skip strike butterfly is at, and then we'll look at a trade in Netflix around earnings. So thanks for coming. Click subscribe, ring the bell, and we'll see you this Wednesday at 11 a.m. Eastern time for the next edition of Options Guide TV. Hope to see you in the hub. Bye, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actually actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.